Okay, everyone, welcome. If you're new to the channel, we cover stock market technical analysis. I really just try to point out what I'm seeing in the charts and what the charts are telling me is likely to happen in the future. Nothing's guaranteed, especially in the markets. Nothing's guaranteed. So in the end, what we try to do is look at the probabilities, look at the technical signals that the markets are giving us, and then anticipate what's going to happen, and then ultimately manage the trade. You got to manage your risk through position sizing, stop losses. You have to understand all the technicals in terms of how to actually trade something. This isn't just a buy and a hope kind of channel. So again, if you're new, follow along and we'll get into these charts. What I think is going on this morning is the markets look like they're right on the edge of a big sell-off. We haven't seen it yet, but I want to point out the things that I'm seeing that are telling me that we're really close. Let's start out here with the SPY. We're hovering here on the hourly chart just above my blue line right here, and just marginally above it. What's the blue line? Well, if I go to the weekly chart and I scroll all the way back to 2009, that's your Great Recession lows. And you can see we had lots of times where we hit this as support on the weekly chart all through here. And then what we broke in 2018. So this is when I feel like the bull market actually died. But I mean, obviously the price action isn't showing that because the Fed has been keeping it propped up, or trying to at least. So again, 2018, Fed reversed course, cut interest rates, multiple expansion through 2019. Then we got the COVID drop. Fed cut more interest rates, did more quantitative easing, got more multiple expansion. And this is where we're sitting at right now on this chart. So going back to the hourly, just slightly above it, but no, this is kind of, this is the area where should get rejected. And again, I talked about this in earlier videos where I anticipated that they would probably pop this level. Since we were right on it, I figured, okay, we'll probably pop it, run some stops, then reverse. So, as of right now, it looks like we popped it. We're just kind of running stops is what it looks like. So I'm looking for that reversal. One thing that I want to point out, and let's look at the Qs. Tech sector, same deal. We've got this bearish rising wedge here on the tech sector. You can see this rising wedge right there. My trend line that I'm mostly concerned about is this lower green one right here. This is coming off the COVID lows in March 2020. Held support, bear trap. That was a false breakdown. I suspect the next breakdown that we get, it's not going to be a bear trap. But that's what I'm looking for, is ultimately a breakdown of this level all the way down here. Now, as of right now, we're just kind of hanging out at the upper end of this bearish rising wedge. So no sell signals, nothing that's like telling me, okay, today's the day, but I'm seeing things that are telling me that we're close. And I want to point those out next. The other thing I want you to notice is on the daily, we still maintain bearish divergence right there. This is all divergent high price action. So all of this is a divergent high. On the triple Qs, and on the SPY, same deal, divergent high price action. See how the momentum is just struggling to make newer highs, and it's just the price continues to kind of grind higher, but momentum is just kind of, it's struggling to make newer highs, and that's divergent high. That's a divergent high basically. Momentum is diverging, signaling that momentum is fading, and price just hasn't caught up yet. So again, we use momentum to try to tell us where price might go, and then we look for breaks of key support levels to signal the sell, for a sell signal, or a position trigger when to actually get into a trade. So again, to me, it looks like the markets are just kind of hanging out in this area, run some stops, and then going to roll over. One thing, so here's the main thing I want to point out really in this video is TNX. So TNX it tracks the 10-year treasury yield, and you can see we gapped up today. So we have a breakout now in yields. Yields are rising basically. And what I want to point out is if you look back here, here's a downtrend line in TNX that really, this is going back to November of 2018. So if anybody, you think back in 2018, the Fed was raising interest rates and reducing their balance sheet. The market dropped 20% and the Fed said, oh, sorry, actually, we're going to start cutting rates and adding back to the balance sheet. And that happened basically right around this timeline of, late 2018. And so this is the Fed's been cutting interest rates ever since for the last few years, and we've been downtrending. And you can see we hit the COVID drop, plunge down here, but recently, look what's going on. We're coming right up. We came right up to this trend line, kind of broke above it, and today we're gapping up and running higher. So interest rates are spiking basically. That's not good for risk assets. That's not good for the market. Now, they're going to try to spin it on the mainstream media that this is a reflation trade and it's signaling a stronger economy is coming back. But it doesn't really matter from my perspective whether the economy is becoming stronger. There's so much debt across the board, corporate debt, government debt. There's just so much debt that we just nothing can afford higher interest rates. The debt just can't maintain it. So this is negative any way you spin it. The economy's strength is not going to come back and erase away the debt that we've taken on. So it is, it's going to be a drag on the markets. So watch that. Watch these interest rates. Now, if these just drop and collapse and this is a false breakout, okay, then, I can see that. So again, what I would look for, the Fed's probably going to come out here pretty soon. You're going to hear something from the Fed. I don't know how long they're going to let this thing run. I suspect they're not going to let it go too much higher, but we'll keep an eye out for that. Let's look at TOT. So TOT is the long bond, kind of the inverse of the TNX. It's just signaling what bond prices are doing, and the long bond is gapping down today, and that is a big move in the long bond. So again, really what this is signaling is there's going to be some disruptions in the markets. You can see, I can probably adjust this slightly, but basically we've gapped kind of down to support. On TLT, you've got support right along this trend line. We're hitting it right now, but the thing is on the daily, we blew through that negative or that bullish divergence. You can see here made a new lower low here. So we'll watch this, see how the day closes. If the day can spike back up, perhaps they can, perhaps they can keep this divergence intact. But as of right now, breaking through that bullish divergence, signaling that just we're in a clear downtrend in the long bond. Not good for interest rates. So interest rate sensitive things should be affected. So we'll look at oil here. You can see oil. Oil they gapped it higher today, kind of selling off into the morning. Nothing substantial yet. So we'll just continue to watch this. But if interest rates continue to rise, I would, we're going to want to watch the dollar and the interest rate sensitive assets. The other thing, the dollar. So the dollar's this is the DXY, which is traded against the euro. So it's basically the dollar rising against the euro. If the it's really those two for the most part. But if they're both falling, you could have the dollar falling and the euro falling, or the dollar rising and the euro rising, and the DXY is not going to show, it's not going to show the dollar weakness against other commodities and stuff. So you can't just use the DXY. It really just is a dollar pairs. It's really, the yen's in there and some other things, but for the most part, it's dollar euro. Dollar's rising a little bit against the euro today. Not much. Okay, so if the dollars, or not the dollar, but if the interest rates are going to rise, then mortgages are going to be more expensive. And that means the home builders aren't going to sell as many homes. Home prices are pretty much inverse to interest rates. Interest rates drop, home prices go up. Interest rates rise, home prices fall. That's why with real estate, and I used to do house flipping and stuff a couple years ago. I haven't done any for a while just because of the prices of homes. But the real estate market has been on a tear, and I have been kind of telling people I think it's at a relatively it's at relatively the highest it can go. Now, yes, the dollar can continue to fall, and that can continue to put upward momentum on real estate prices, but it's kind of a one for one in that situation. You get the dollar falling and real estate's going up in dollar terms, but the dollar is losing value, so it's kind of a wash. You sell your house for a high dollar value and you go to buy something and you can't buy as much. So it's kind of a one for one. The interest rates is where potentially you get kind of some extra value or price action, purchasing power out of your home. And as interest rates start to rise, that should start to put pressure on mortgages, making them more expensive. And mortgages being more expensive with home prices pretty much at all-time highs, you've now got an affordability issue where people just can't literally afford to buy that house for that price. So house prices have to start coming down because houses ultimately sell for what people can afford. So these home builders like Lennar, hourly chart, you've got this rising trend line here. And starting to break right there, not impulsive yet, so I don't know if they're going to do it today. I don't see bearish divergence really on this Lennar, so not the best chart. Here's Pulte Homes. This one does have bearish divergence right there on the RSI, not so much on the PPO, although if you scroll back, it's got it kind of going back to there. We have this daily trend line right here, and we're coming down to it, but it has not broke. So no sell signals yet. Lennar, maybe, we'll watch to see if this picks up steam. Might be a sell signal. And I would look for this to come down to this trend line here at about 71.30. And a break of that signals, potentially a lot lower prices. We've got some support down here, it looks like, right in this area. Right around there, which is about 57. So we'll watch that. Something to look at. Okay, the other thing to look at, Apple. So we've been looking at this trend line right here. Here's the trend line coming off July 2020. Just been kind of walking up this trend line for a while. And recently you can see, as I zoom in, we hit it, bounced, hit it again, bounce, but it was a less of a bounce. That's something to kind of pay attention to. You bounce, you have an impulsive bounce, you make a new high, then you hit it again and you bounce, but you don't make a new high, and you don't, you get about halfway there and then start to sell off and head back towards the trend line. So something to note there. That's just kind of reading the chart. What, that doesn't mean anything. It just means that the bounce wasn't as good. It's not as impulsive. So then you look for signs of other weakness like negative divergence, which you see we have clearly negative divergence on Apple on the daily chart. That's another sign of weakening momentum. And then you start looking for breaks of that trend line. As of today, you can see right there, starting to break. So if Apple breaks, the market's going to break. It's just the nature of the market cap weighting that Apple carries with it. Of course, you want to see some of these other things break support as well. But it's really hard for the market to move substantially higher when Apple is selling off. So watching for this breakdown, it's as of right now, if I go to the hourly, you can see it has broken, that is a sell signal. We've got a couple minutes, 4 minutes before this hour closes. So obviously they could recover it, but, and then we'll look for continued selling. All right. You want to see continued selling. If there is continued selling, then you go back to the daily chart and see that we have now broken this uptrend line with negative divergence. So I would anticipate, a breakdown. First level of support looks to be right around 130.24. Next level, we've got kind of a zone right here, about 126.50. So we're going to watch those. Here's Microsoft. So it hasn't broken or anything. The thing to watch on Microsoft that I'd really be looking for is a breakdown back below this level, 227. So it's down there a ways. From where we're at now, that's a drop still of about 6% or so, but it could get there relatively quickly. A break back below this area would signal that this was a false breakout. All right, that would be very bearish. If that happens, we're likely to head down to the bottom of this zone around 199 and likely a lot lower. Amazon already had a false breakout, which was right here, and it hasn't been above there really since. So this was earnings right there, sold off right after earnings, and it's been slowly going down again, in the beginning, when something's downtrending, especially after a long extended uptrend, it doesn't start off impulsive typically. You might get a gap down where it traps some people, but then you're going to kind of hang out in an area as people try to figure out what to do. It will pick up speed as the sell-off continues, because people will start to exit, and then at the end you get panic selling where markets typically just plunge, and that usually signals the end of the move. So that's just kind of the nature of how things fall. And I'll wrap up with Tesla real quick, because again, Tesla was the momentum stock that I think started it all when it came to this retail mania that we're seeing kind of happen right now. I think Tesla was the stock that really started it all. And so, I'm watching this because I think a break in Tesla might signal the end of this mania. So on Tesla, 800, it's about 801 to 800 is the level to watch. You can see here on Friday what they did. Basically, started to break, but then they gapped it right, or recovered it and then ramped it up into the close. Today they're selling it back down. We're below that level right now. We want to see that daily close below there. If you go to the daily chart, we haven't really had a close below that level. I got my line marked here at about 801. I think it's really about 800. Well, we did have a close right here, which was a false breakdown. So ideally, 2 daily closes in a row would be the best. You get the breakdown and confirmation. But I think if you get a daily close that's a little bit more than just a marginal close below this 800 level, that's going to set it in motion to the downside. First level of support that I have on this is about 626. So probably come down, hit that, bounce off of that. But again, that's down there a ways from where we're at right now. That's a drop of about 20%. On the daily, big negative divergence that's just remained intact, hasn't gone away. Negative divergence is not a reason to short something or to get out of a long, but it is a signal that tells you momentum is starting to fade. So then you look for the price to start to fade, basically. And so that's why we're watching this 800 level. A break of that should signal that price starting to fade. All right, guys, that's all I got. Kind of this early morning video. If anything gets crazy, I'll put another video out, and I'll catch you guys on the next one.